Welcome back, everybody. Today we're going to be covering Chapter 3, Cost Behavior and Forecasting. So let's talk a little bit about some of our learning objectives for this chapter. The first one, we want to explain the meaning of cost behavior and define and describe fixed and variable costs. Define and describe mixed and step costs. Let me just check, make sure. Okay, recording sounds good. Sorry about that. All right, define and describe mixed and step costs. Separate mixed costs into their fixed and variable components using the high-low method, the scatter graph method, and the method of least squares, also known as a regression method. Then we want to lastly explain the difference between the absorption and variable costing. Okay, we can see we have a fifth learning objective, Appendix 3A, which is the use of a personal computer spreadsheet program to perform the method of least squares. I'm not going to get into that today. This is enough material as it is. It's a long enough lecture as it is. So if you're interested on that on your own, you can get into that if you're interested. Reason being is because everyone can use different systems and software, so I'm not really going to get into just a personal computer spreadsheet, even though it is a good skill to have. But if you get the content we're going to go over with objectives 1 through 4, then the fifth objective should be self-explanatory, just using a personal computer spreadsheet. Okay, so let's go ahead and get into this chapter. So what are the basics of cost behavior? So it says here that cost behavior is the foundation upon which managerial accounting is built. It's going to describe whether a cost changes when the level of output changes, and whether costs can be variable, fixed, or mixed. Okay. A cost that does not change in total as output changes is a fixed cost, right? So we established that last class period, that a fixed cost is a cost that does not change in total as output changes. Okay, a variable cost, on the other hand, increases in total when an increase in output, and a decreases in total with a decrease in output. So once again, variable cost is going to be dependent upon the level of output. Okay, increases when output increases, decreases when it decreases. Knowing how costs change as output changes is going to be essential to planning, controlling, and decision making. Okay, measures of output and the relevant range. Okay, fixed and variable costs only have meaning when related to some output measure. Okay, so what do we mean by output measure? So what we mean by an output measure is how much are we actually going to produce, or how much is this company going to put out within a period. Okay, so a cost driver is a causal factor that's going to measure the output of the activity that leads or causes the cost to change. Okay, so identifying and managing the drivers is going to obviously help managers better predict and control what costs are incurred within the company. A good example is weather is a significant driver in the airline industry. Okay, so how is that a cost driver? Weather can be a cost driver because, for one, I don't know if anyone's experienced it when they go to fly somewhere. If the weather is bad enough, it can even prevent you from taking off in a plane, right? So it can back it up. It could be a backlog on the flights of when the timing of the flights happen. So that right there is going to throw off the whole day's production, right? What if we're in the air? Obviously, if there's a major storm, we might have to circle around before we can land. So it's going to clog up the airspace, right? It can determine how many flights can be in there. If you have to circle around in the air and wait to land, obviously your fuel cost is going to increase. So that weather is definitely a significant driver in the airline industry. That's how that example explains how it's a significant driver. Okay, what about the relevant range and cost relationships? The relevant range is the range of output over which assumed cost relationship is valid for the normal operations of the firm. Okay, this is going to limit the cost relationship to the range of operations that the firm normally expects to occur. So pretty much the relevant range, long and short, it's just a relevant range of output. So what is the relevant range? So we know for a company, a relevant range of output, say for a car manufacturer, maybe they produce between 1,000 and 1,200 units per month. So that's going to be our relevant range right there, that we're going to be concerned with what the cost relationships are within that relevant range. Okay. So we can see here the following graph is going to show the relevant range, which is all obviously going to enable managers to assume a linear cost relationship. Okay, so we can see here these are nice little charts here. We got the cost on the left on the vertical axis, and the volume right here on the right on the horizontal one. We can see here, just in the center, the relevant range. Okay, this is going to be the relevant range that we just established from the last slide, right? We can see here, this is a straight line approximation, the blue staggered line or the dotted line right here, or perforated line, I should say. And then the curvilinear line function is going to be the one in the red where it changes, right? Okay, so that's just a little visual of what the relevant range and cost relationships are. Let's talk about fixed cost. Once again, we touched on this concept in chapters 1 and 2, but let's go ahead and expand on this concept. So these are going to be costs that in total are constant with the relevant range as the level of output increases or decreases. So here fixed costs are unchanged, they're constant, right? It doesn't matter. It's not going to vary based upon the level of output increasing or decreasing, right, as variable costs would. So fixed costs are extremely important to understand because they usually are relatively large in amount, right? Effective business decisions involving financial estimations often include fixed costs. So in this example of Kali computers, notice that while the total fixed cost of supervision remains the same, the unit cost decreases as more computers are produced. So let's go ahead and look at an example here. So on the left, we have the number of computers produced from Kali Computers Incorporated, okay? The total cost of supervision is in the middle column. And then at the end, we have the unit cost, right? So, or the cost per unit of each computer being produced. So as we can see here, if they produce 20,000 computers, total cost of supervision is 32,000. If you notice, this does not change. So the total cost of supervision, this is a fixed cost, right? But as we can see, the unit cost at 20,000 units of computers produced, it's only at $1.60 unit cost, right? Look here as we move down, 30,000 units of computers produced. Total cost of supervision doesn't change. It's 32,000. That's our fixed cost. But now we produced 10,000 more units, but now look at our unit cost. It's dropped all the way down to $1.07. Okay? Let's skip 40 and move down to 50,000. Notice our total cost of supervision is unchanged. We're held intact at 32,000, but now our unit cost is down to 64 cents per unit. So you can see as the number of computers produced, the unit cost, your variable cost is actually going to decrease, but your fixed cost stays the same, right? Okay. The number of computers processed is called the output measure or the driver. Okay, so that's going to be the output measure, and driver is the number of computers that we're going to be processed or produced. So even though fixed costs may change, this does not make them variable. Okay, they are fixed at a new or higher or lower rate. So fixed costs can change. So like it says, that does not mean that it goes from a fixed cost to variable cost. All that means is that now you have a new fixed cost. So it's either increased or decreased to a new fixed level, okay? So once again, a graph of Kali's fixed supervision cost is going to be shown below in this graph. So we can see here, units of produced is on the bottom on the horizontal axis. On your vertical axis, you have the cost, okay, so incrementally increasing as we go up, move up vertically on the line, and units produced as we move out to the right is going to increase as well. But we can see here that the cost of supervision of $32,000 is fixed no matter how many units we produce, right? So it's a fixed cost. So this is just an actual visual on a graph here, so we can just see it's something different than just a verbal explanation of it. A lot of times it's good to get a visual of what you're reading. Okay, once again, these are going to be some examples of how these theories and these concepts are going to be applied and used, whether it be in your personal life or at some of these makeup companies like Kicker. We use some examples from chapters 1 and 2. For the purpose of getting through this lecture and not boring people and dragging it out any longer, I'm going to have you all read these here's how it's used examples on your own as you're going through the PowerPoints. There is a copy of the PowerPoints that are posted in Moodle, So you can pull those up as you're going through this, hit pause on this, and then just review these in your PowerPoint slides. That way you get a gist of what's going on in these examples and help explain to you the concepts that are being covered. But for now, I just want to let you all do this on your own time, and let me just get directly to the concepts and the stuff that's going to be seen on the quizzes, homeworks, and the exams. So once again, pause this and read this on your own time before we move on. So once again, there's 5 slides here. I'll give you a little, I'll click through them shortly here so you get an idea of what you're looking at reading on your own. Okay, and now we're back off to getting into another concept here. So now let's talk about discretionary fixed costs versus committed fixed costs, okay? So there's going to be 2 types of fixed costs, right? Discretionary fixed cost and committed fixed costs. So what's the difference between the 2 of them? Let's start off with discretionary costs. These are going to be fixed costs that can be changed or avoided relatively easily in the short run at management discretion, okay? On the other hand, committed fixed costs are going to be fixed costs that cannot be easily changed, okay? So I think we can get the difference between these. We can infer between the 2 of these based upon their names themselves. Discretionary, at management's discretion, they can change these fixed cost levels, right? Whereas committed fixed costs, we're committed for the long haul, right? That it just is what it is. What about advertising? That'd be a good example of a discretionary fixed cost, right? Because advertising is going to be dependent upon a management decision on how much they choose to advertise for that period, right? So they could either choose not to advertise, they could advertise a little bit, they could advertise a lot. It's up to their discretion, right? Totally a management's decision. What about a lease cost on the other hand? Isn't that going to be a great example of a committed fixed cost? Think about it, because if we sign a lease, we have a contract with that lease, right? So us as a leasee has a contract with the lessor. We're not getting out of that, right? Unless we would sublease it to someone else, right? So that we're committed to this. So it's going to involve a long-term contract, and it's going to be a fixed amount no matter what. It's going to be the same payment every time, and we can't change that unless we sublease it, okay? So let's talk about variable costs. These are costs that vary in direct proportion to changes in output within the relevant range. Once again, remember, we want to stay within this relevant range. Anything outside of it could really distort the overall picture of what the cost is that we're trying to infer here. Okay, so variable costs are part of several critically important performance measures. These performance measures are going to be used throughout managerial accounting, okay, including contribution margin, segment margin, and variable costing. Variable costs can also be represented by a linear equation. And then once again, total variable costs are going to depend on the level of output, okay? So obviously we know that. Total variable cost depends on the level of output. Because why? Variable cost, as the amount of output increases, usually those variable costs increase. Same thing on the opposite end of the spectrum. So if they decrease the level of output, usually variable costs are decreased. So once again, they're dependent. These total variable costs are dependent upon the level of output. This relationship can be described by the following equations or graphs. So once again, we see the equation, right? So total variable costs is going to equal the variable rate times the amount of output, okay? So meaning if it cost us $5 to produce a pair of tennis shoes, okay, that's our variable rate is the $5, okay? And then we're going to multiply that by the amount of shoes that we produced, how many pairs of shoes at $5, the variable rate of $5. So that'll give us the total variable cost, okay? So if we have 10 pairs of shoes produced at a variable rate of $5, then obviously we're going to have $50 is going to be our total variable cost in that scenario, right? So let's look here, the variable cost in total. So we can see that here, same chart here, as you can see on the horizontal axis down here for the volume. But what only difference is one is showing us the variable cost in total, one shows the variable cost per unit. Okay, so we know in this case they're saying $20 is the variable cost per unit, right? It's just showing no matter how much you increase the volume of production right here, the variable cost per unit is unchanged. It's constant, right? So that's why it's just going to be a horizontal line right here because it's just holds true. It's a constant variable cost per unit as the volume increases, okay? However, variable cost in total is going to increase if we produce 2,500 units, right? Then the total cost of that in units for the total variable cost is obviously going to be $50,000, right? Because it's $20 per unit. 2,500 times $20, 50,000. If we jump from producing 2,500 units to 5,000 units in volume, then obviously 5,000 times $20 is 100,000, and so on and so forth. Okay, but we can see the variable cost does not change. Variable cost per unit is unchanged with the volume produced, whereas the variable cost in total does change because we're, once again, remember, it's dependent upon the amount of output, right? Once again, this is another one of those examples of here's how it's used. Once again, this is to be read on your own timing, on your own time. So read through this, hit pause, go through your PowerPoints, and then come back to the lecture when you're finished with it. This one's only 2 slides here, so 2 quick little paragraphs there. Okay, now back to the content. So what's the reasonableness of straight line cost relationships? Okay, so what's the reasonableness of these straight line cost relationships? We have to be cautious when applying the cost behavior assumptions to the different output levels that fall outside of the company's relevant range of operations. Remember, we're back to this relevant range of operations, right? So once again, we're showing the importance here of staying within that relevant range, okay, within the company's operations. Straight line cost relationships that are assumed within the relevant range may actually be semi-variable costs, okay? So we need to be careful with that. Okay, I went backwards here, sorry. I don't know what just happened. Hold on just a second, let me find myself. Okay, here we go. Sorry, I don't know how that happened. Okay, so once again, straight line cost relationships that are assumed within the relevant range may actually be semi-variable cost, right? So I do apologize, I clicked way down. Okay, a good example. At extremely low levels of output, workers often use more materials per unit or require more time per unit than they do at higher levels of output. So what do they mean by that? So at lower levels of output, workers often use more materials per unit, require more time per unit than they do at higher levels of output. So pretty much what it says here is as the level of output increases, workers learn how to use materials and time more efficiently, so that the variable cost per unit decreases as more and more output is produced. So let's just think about this. So let's just assume that we're building a deck, okay? When we first get started, say there's different steps to building a deck, okay? First, you have to do all your measurements and your markings, okay? Then you have to dig your posts and dig your holes for your posts, pour your concrete and all this stuff. So as we're digging these posts and these holes, we're going to find out ways, maybe little shortcuts of how we can dig quicker, right? Maybe we're going to use a better machine to dig, or maybe we just learn a better process of doing so, okay? Same thing setting posts. You have to get them to balance, okay? The first couple posts we set, we're kind of trying to find our way, find our routine, right? But as we continue to set these posts, we learn from our mistakes in the prior post that we're setting, and it becomes easier to set the post, right? So it's the same thing. As the level of output increases, workers learn how to use materials and time more efficiently, because obviously it's the same song and dance, everything. It's just repetitive. So as you repeat something, remember, repetition is the father of learning. It's the same thing as the level of output increases. You become more efficient in what you're doing because you learn from your mistakes and you get better at it. So once again, the variable cost per unit decreases as more and more output is produced. So semi-variable cost, the decreasing rate, okay? Obviously, we see here units produced, 10,000. As we move to the right, it's more units produced, right? This is a straight line assumption with the perforated line right here, right? Here's our relevant range, okay, of the relevant range of output produced. In this case, it's anywhere between, looks like it's 30,000 and 15,000 is their relevant range. See here, the cost increases as with units produced. So what they're saying here is semi-variable cost decreasing rate. So as we get better of producing goods and services, we can see at first it's getting more and more expensive, but then the cost starts to flatten out right here as we become more efficient with our process. So this is just once again just a little visual of what we just read. This, on the other hand, is an increasing rate, okay? Then when it's the units produced, okay, as we produce more units, it gets more expensive, okay? And there's a relevant range, and the perforated line is going to be your straight line assumption, okay? And this is the increasing rate semi-variable cost, okay? Once again, this is the decreasing rate. This is the increasing rate. Okay, once again, here's how it's used example. Read through this on your own time and tie it into the theory that we just covered, or give you another example of how it's used in a real life. Once again, we have a lot of material to cover, so I'm not covering this, so do this on your own time. There is 3 slides here in relation to how it's used with sustainability. Okay, next, let's talk about mixed costs. What are mixed costs? So these are going to be costs that have both a fixed and a variable component, right? So it's going to be both fixed and variable costs is going to make up what mixed costs are. A good example is overhead for a company may consist of a fixed supervisor salary plus the cost of supplies that vary with the quantity of output produced. So in this case, obviously, we have a mixed cost because it's made up of fixed and variable costs. The fixed in this case being the supervisor salary, and then the other one, the variable, is going to be the cost of supplies that vary with the quantity of output produced. Okay, so the formula for a mixed cost is going to be total cost equals total fixed cost plus total variable cost. Makes sense, right? So total cost of a mixed cost is going to be total fixed cost plus total variable cost. So once again, let's just look here. So sales expense here is going to equal the total. So in this case, it's going to be $300,000 as our fixed cost, plus $25 is going to be the variable rate, times X. X is going to be the units sold, okay? So this pretty much is just punching in a little bit of numerical data into this cost behavior formula, okay? Let's talk about step costs. These are going to be narrow steps, okay? So there's going to be both narrow steps and then wide steps, okay? So some cost functions may be discontinuous, okay? This is known as step cost or semi-fixed, okay? It displays a constant level of total cost for a range of output and then jumps to a higher level or steps up for a total cost at some point where they remain for a similar range of output. Okay, so once again, this is the step cost, and we're going to get an example of this right here. So step cost with narrow steps, okay? Once again, the cost is going to increase with the number of units, and it's going to do it proportionally in steps instead of just on an actual line graph like we were seeing before. Okay, now let's talk about wide steps. Okay, step costs with wide steps are more characteristics of fixed costs. Okay, so a good example of this is a company may have to lease production machinery. Okay, if the machine can only produce 1,000 units and the company is going to grow, then they will have to lease additional machines for each 1,000 units of production needed. Okay, obviously this is going to result in the wide steps shown in the following graph. So let's just look at this here based upon this example. So step cost with wide steps. So once again, we can see it's the same thing with the short step with step cost, but those are a little more shorter, whereas these are longer periods, like wider steps. So what that's saying is from the previous example, remember we leased a machine for X amount of money, right? That produced 1,000 units. So if we grow, and now we need to produce more than 1,000 units, then we have to incur the cost of leasing another machine. That's what steps our cost up. And then as we produce those numbers, there's another increment of 1,000. As we grow some more, we need to purchase another machine, lease another machine's rights to use for another 1,000. That's our next step up. And you can see that it's in a wide steps because the wide steps counts as the 1,000 units being produced, number of units. So that's the difference between the wide steps and the narrow steps. And remember, the wide steps is going to be more in regards to your fixed cost, whereas the narrow steps is going to be more to the variable ones, okay? So what about the accounting records and the need for cost separation, okay? Only through a formal effort to separate costs can all costs be classified into the appropriate cost behavior categories. If mixed costs are a very small percentage of total costs, formal costs, separation would be more trouble than it's worth, right? So what do we mean here? So there's some type of a cost benefit that analysis that has to be done, right? So what they're saying, if mixed costs are going to be so small of a percentage of total costs, formal costs, then the separation of it is going to be more trouble than it's worth. You're better off just clumping it in there because the cost is what the cost is. Okay, it'll be more headache and cost more money than what the value derived from separating those or bifurcating those costs would be than to just leave them as one component. Okay. So mixed costs could be assigned to either the fixed or variable cost category without much concern for the classification error or its effect on decision making. But alternatively, the total mixed cost could be arbitrarily divided between the two cost categories. Just want to point out that, as it says here, this is very rarely done, and it's really not a good option, okay? Because you're just arbitrarily dividing them, okay? So that's not going to give you a true depiction of bifurcating these costs or separating these costs. When I say bifurcation, bifurcating, that's separating them, okay? Typically, mixed costs for many firms are large enough to call for separation. So most of the times, mixed costs are gonna need to be separated, okay, to truly get a true cost breakdown of what's going on. Here's another how it's used. In this scenario, it's in your own personal life. So once again, got a lot to cover. Read this on your own time. There's 4 slides here. Hit pause, go back to your PowerPoints, read through this, relate it to the topics just covered. We'll flip through them real quick, let you get a generalization of what you're looking at. Okay, let's talk about some methods for separating mixed cost into fixed and variable components. Okay, so now we're going to start separating these mixed costs into fixed and variable components. So the purpose of creating a cost formula is to provide a quantitative estimate of both total fixed costs and the variable costs per unit of the cost drivers. Cost formula components are determined, then managers can predict total cost at various levels of output. So once we take these cost formulas, right? So once we have the cost formula, the managers can use this as a tool to base it upon the level of output they want to produce, because then they can see what the total fixed cost is going to be based upon a total output of production, right? So that's why this could be very useful to managers and the decisions that they ultimately make for the firm. So 3 commonly used methods of separating a mixed cost into its fixed and variable components are going to be these 3 as follows. So first we have the high-low method. The second is the scatter graph method. And the third being the method of least squares, which is the regression method. So each method requires the simplifying assumption of a linear cost relationship, okay? Expression of cost as an equation for straight line is going to be the total cost, okay, so the total cost of an item equals the total fixed cost plus the variable rate times units of output, right? So once again, total cost equals total fixed cost plus the variable rate times units of output. Now the dependent variable is a variable whose value is going to be dependent upon the value of another variable, okay? So in this equation here, total cost is going to be the dependent variable, okay? Because the reason why it's going to be the dependent variable is because it's the cost that we're trying to predict, okay? So we're trying to solve for total cost. Total cost is going to be dependent upon the side of the equation over here, okay? Upon the total fixed cost and the variable rate and units of output produced, okay? The independent variable explains changes in the dependent variable. A good independent variable is one that causes or is closely associated with the dependent variable. Many managers are going to refer to the independent variable as the cost driver, okay? The intercept corresponds to the fixed cost. So the intercept on the line graphs that we're going to look at, that corresponds to the fixed cost. So when we find the intercept, that's our fixed cost, okay? The slope of the line corresponds to the variable rate, okay? So let's do an example here so we can actually see what we're talking about. So how to create and use a cost formula. So let's assume that the Art and Graphics Department of State College decided to equip each faculty office with an inkjet color printer. Okay, let's assume for this example that the computers were already in place at the time of the inkjet colors being installed. Okay, sufficient color printers had monthly depreciation of $250. Okay, the department purchased paper and boxes of 10,000 sheets for $35 per box. Okay, ink cartridges cost $30 and will print on average about 300 pages. So it's asking us to do two different things. We need to find two different things here. So the requirement is to create a formula for the monthly cost of inkjet printing in the department. So based upon this data here, let's see how we can create a formula to be able to determine the monthly cost of inkjet printing. Okay. So once again, we need to know the cost formula, right? So once again, what is the cost formula? It's going to be total cost equals fixed cost plus the variable rate times the number of pages. Okay, so knowing this formula, now we just have to take the data that was given to us in the problem and punch it into the formula, okay? So let's see here. The monthly fixed cost is going to be the $250, which is the cost of the printer depreciation, right? So we know that's our fixed cost. So that's given. So there's one of the components of this formula that we're trying to punch in already. So that's given. Fixed cost is $250, which is that of the printer depreciation. The variable costs are going to be the paper and the ink, right? Because that's going to vary based upon the amount we print. We need to account for the cost of the paper and the ink, because when you print a document out, it consumes both. It's going to consume both ink and paper, right? So that's our variable cost. So the cost of one page of paper is going to be 0.0035. How do we find that? So the cost of one page of paper, let's look back at our example here. So it says the department purchased paper and boxes of 10,000 sheets for $35 per box. So how do we find that? The numerator is the cost of the box of paper at $35. Your denominator is going to be how many sheets are in the box that you purchased. In this case, 10,000. So $35 divided by 10,000 is going to yield 0.0035. So that's the cost of paper per page, okay? What about the cost of the ink per page? So once again, let's just take what they were giving us. They say ink cartridges cost $30 and are going to print about 300 pages, okay? So once again, let's go back to our formula here. If we punch in the numerator as the cost of the ink, okay, which is $30, and it's going to roughly print about 300 pages. So that's going to be the cost of ink per page. 30 divided by 300, that's 10 cents per page. So therefore, our variable rate per page is going to be the cost of the paper per page and the cost of the ink per page. So if we add those up, we can see that 0.0035 and 0.10 is going to equal 0.1035. Okay, so that's our variable rate per page. The cost formula, so the total cost of printing, we know that because remember total cost. So total cost of printing equals fixed cost of $250 for depreciation plus the 0.1035, so a little over 10 cents, okay, times the number of pages printed. So there's our formula, total cost of printing formula, right? Makes sense. Okay, let's take it a little bit farther here. Remember the second thing, if the department expects to print 4,400 pages next month, what is the expected total fixed cost, total variable cost, and total printing cost? So we've already created our formula, right? So now we just need to punch it in here. So we have the fixed cost, that we have the variable rate, right? So now we just need to punch in the number of pages, which once again was given to us. It says that the department is going to expect to print 4,400 pages next month. So all we have to do now is go in here and take the expected fixed cost for the next month. Wait, that's given, right? $250. So there's our fixed cost. That's one of the answers they asked us for. That was given already. Expected variable cost for next month is going to be the cost per page for the piece of paper, and the cost per page for the ink to print on it, which we remember is a little over 10 cents at 0.1035. All we have to do is multiply that by the number of pages that we expect to print the following month, which was given 4,400 pages. So if you take 0.1035 and multiply it by 4,400, it'll leave us with $455.40. That's going to be our variable cost for next month. So now, obviously, if we can find expected total printing cost for next month, because we have the fixed cost and the variable cost. So now all we have to do is add those two together, and that'll give us the total printing cost for next month. Okay, let's talk about some other methods for separating mixed cost into fixed and variable costs. So once again, this is gonna be some data given to us for the high-low point method. Okay, so we're gonna come back around to this data in a minute. So this is just how we're gonna look at it. We'll have the month in which the data is occurred, material handling cost, and number of moves or number of units. Okay. So once again, when you see something like this, that means we're about to use the high-low method. So given 2 points, the slope and the intercept can be determined, right? So if we can find 2 points on a line graph, then we can find the slope and the intercept from just those 2 points. So the high-low method is just a method of separating mixed costs into fixed and variable components by using just the high and low data points. The high-low method is going to provide managers a quick way to estimate cost behavior. So this is just a quick way to see some of the cost behavior that's happened throughout a period. So let's look at a little demonstration here. Let's use the data from materials handling costs at Anderson Company, okay? There's going to be 4 steps that must be taken into the high-low method, okay? So step 1 will be to find the high point and the low point for a given data set, okay? And we're going to get into that on some slides to come. I just want you to pay attention to the different steps right now. So once again, step 1, find the high point and the low point for a given data set. Okay, so using these high and low points, next we want to calculate the variable rate. So we can see this formula right here. It says variable rate. So once again, this is what we're trying to find, right? So the way we're going to find that, the numerator, the high point cost minus the low point cost. Your denominator is the high point output minus the low point output. And that right there is going to leave us with the variable rate. Okay, so that's the first 2 steps. The third step, we want to calculate the fixed cost using the variable rate from step 2 and either the high point or the low point. So once again, we want to find this fixed cost using one of these 2 points, right? So once again, the variable rate, this is steps 1 and 2. So the variable rate that you find by using this formula, the high point cost, low point cost is your numerator, the denominator, high point output minus low point output. Once again, that's the variable rate. That's going to be used for step 3. As we can see here, fixed cost equals total cost at high point minus variable rate times output at high point, okay? Then the last step from the cost formula for materials handling based on the high-low method, okay? That can be done, obviously step 4, that's going to happen by applying steps 1 through 3. Okay, let's look at an example of the high-low point method. So Blue Denim Company makes blue jeans. The company controller wants to calculate the fixed and variable costs associated with electricity used in the factory. So data for the past 8 months were collected. So once again, here's our months on the left. We have that first 8 months of the year, January through August. In the middle column, we have the electricity cost for each month, and then the machine hours that was used based upon that cost of electricity for the month, okay? And remember, the company controller wants to calculate the fixed and variable cost associated with the use of electricity, right? So the consumption of electricity is what we're concerned with here. Okay, so required, using the high-low method, calculate the fixed cost of electricity, calculate the variable rate per machine hour, and construct the cost formula for total electricity cost, okay? So what's the first step we want to do? Find the high and low points, right? Okay, so right here it says the high number of machine hours is in March. So let's look back at our chart here. Machine hours is on the right, right? So they're saying March is the high number of hours of 600 hours. So we can see that's the highest of all of these. So 600 hours, the machine hours. Notice it's not the cost, it's the hours used, right? So that's the high end in March. The low number of machine hours is in June. Let's look back one more time. June, where is June at? Right here, 350. And we can see from looking at the other machine hours for the relevant months that that is going to be the low point. So we have the high point in March of 600 and the low point in June of $350. Okay, once again, I want to point out August is not the high point because its number of machine hours is not the highest activity level. I just want to point out here, remember, I said it's based upon machine hours, not electricity costs. So you could infer this incorrectly and say, okay, well, August is the high point because it's got the highest electricity costs. However, there's only 509 machine hours being used to produce that cost, right, or to get that cost. So we're more concerned with the machine hours. The high and low points, machine hours, not the cost, okay? So the next step, right? So for step one, we've picked up the high and low cost based upon machine hours, right? We've already established that. So now we want to calculate the variable rate, okay? The variable rate, once again, remember the numerator is the high cost minus the low cost. Your denominator is the high machine hours minus the low machine hours, okay? So we already know the 2 months that we're going to be concerned with for punching the data into this part of the formula here. So let's do our numerator first. High cost minus low cost. Go back to our chart here. High level was in March, so the high cost is going to be 4,100. The low cost was in June, 2,575. So let's go back to our formula. We can see that 4,100 for the high, 2,575 for the low. So we're just punching it in here. What about the high machine hours minus low machine hours for our denominator? Okay, let's go back to our chart here. Once again, high machine hours was 600, low machine hours was 350. So we just basically just punch them in here. We do our basic subtraction here. That's going to leave 1,525 as your numerator. Your denominator is going to be 250. So that's going to leave our variable rate of $6.10 per machine hour. So what's that mean? So it's going to cost us $6.10 to operate that machine per hour, right? Based upon electricity consumption. Now the third step, they want to calculate the fixed costs, okay? Now watch this. Fixed cost equals total cost minus your variable rate times machine hours, okay? So fixed cost is total cost minus variable cost. Once again, fixed cost is total cost minus your variable cost. So let's choose the high point with the cost of 4,100 and machine hours of 600, okay? So the fixed cost, okay, so fixed cost, once again, we're punching in total cost, we know it, right? 4,100 minus the variable, 610 times 600 equals 4,100, right? Minus the 3,660. Where's the 3,660? It's the 610 times the 660. Okay, so that leaves us a total of $440, okay? You can check your work if you want to by computing the fixed cost using the lower point, okay? So if you do it with a high point and find a lower point, you should be able to check your answer here, check your work. So once again, let's look at that. Remember, step one, find the high and low points, right? We just look at the chart, find it based upon the hours used, not the costs. From there, we know the numerator and the denominators. For the variable rate, we plug those in. We find the variable rate per machine hour, right? In this case, $6.10. Then we need to calculate the fixed cost. So we found the variable cost. Now we need to know the fixed cost. Remember, fixed cost is just total cost less variable costs. We know it's variable cost because it's the variable rate times machine hours. So all we have to do there for the fixed cost is just plug in the elements from that point as we went through on the last example. So just look at that for a second. Okay. Last, the step 4, construct the cost formula. So if the variable rate is $6.10 per machine hour, we calculated that. And fixed cost is $440 per month. then the formula for monthly electricity costs is going to be as follows. So total electricity cost equals $440 plus $6.10 times machine hours. Okay, so that's our cost to be able to determine the level of output, or how much electricity is going to be consumed based upon the level of output. Okay, so once again, we have total electricity cost is the 440. What's the 440? That's our fixed cost. What's the 610 right here? That's our variable rate that we found in step 2. Fixed cost was found in step 3. Machine hours, that's just going to be given based upon the machine hours that is used within the period. So recall that Blue Denim Company constructed the following formula for monthly electricity costs. So we got this. Remember, it's the same thing we just carried over from the previous slide. Total electricity cost equals our fixed cost of $440 plus our variable rate of $6.10 times that of the machine hours that are going to be used. So let's see what's required of us next. Assume that the 550 machine hours are budgeted for the month of October. So we're budgeting 550 machine hours for the month of October. Use the previous cost formula to calculate total variable electricity costs for October and total electricity costs for October. So this should be easy, right? The hard part's done. We found our formula. So finding the formula is going to be the hardest part, in my opinion. Then from there, we just punch the given data into the formula that we found. So the first thing, the solution for the first part, remember the first thing it's asking us, total variable electricity cost for October. So what's total variable electricity cost? That's this part right here of it, right? $6.10, the variable rate, times 550, which is what? Machine hours, and it's given here. Total variable electricity cost, which is 610, total variable electricity cost, which is the variable rate of 610 times machine hours that's been budgeted for, $550. So total variable electricity cost that we're going to budget for is going to be $3,355. Now to find total electricity cost, we need to use the fixed cost plus the variable rate times the machine hours. Once again, fixed cost was given for $440. Then we add the 610 variable rate times the machine hours of 550. Obviously, that's going to be 440 plus the 3,350, which you can see is what we found up here, to equal or yield the $3,795 of total electricity costs for the month of October. Now recall that Blue Denim Company constructed the following formula for monthly electricity costs. This is going to see how the fixed cost per month and variable rate were computed. We can look back to examples, but we've already established that. Okay, so total electricity cost equals the fixed cost of $440 right here, plus the variable rate times machine hours. So we've already established that's our formula for total electricity cost, right? So now let's assume that 6,500 units of machine hours are budgeted for the coming year. Okay. So notice this is dealing with an annual period. The last one was dealing with the month of October. So now we're dealing for a whole annual period. So assume that 6,500 machine hours are budgeted for the coming year, not month, year. Use the previous cost formula to calculate total variable electricity cost for the year, total fixed electricity cost for the year, and total electricity cost for the coming year. Okay? So the first thing we want to do, once again, it's asking for what? Total variable electricity cost for the year. Total variable electricity cost equals the variable rate times machine hours, right? This is just that one component of the formula. We know the variable rate is $6.10. We found that. Times the allotted amount of machine hours, 6,500. That'll yield $39,650 for the total variable electricity cost. Okay, what's the second thing they were asking for again? Total fixed electricity cost for the year. Okay, so let's point out one thing here. Remember, I pointed out when I was reading the question, we're concerned with the annual period here instead of a monthly period, right? So that I want you to pay attention to this step right here that we have to add in where since we're concerned with the annual period instead of a monthly period. Okay, so the cost formula is for the month, right? So the cost formula that we create is only for a month period. So we have to alter that formula if we're applying it to a different time period, right? So we need to multiply the fixed cost for the month by 12, right? The fixed cost, which makes sense because the fixed cost is applicable to a month based upon the use of the formula. So if we want to use it for a year, i.e. 12 months, then we need to multiply that fixed cost for each month by 12 to get the annual fixed cost. So you can see here, total fixed electricity cost will be your fixed cost, and which is given, right, the 440, times the months in a year. We know there's 12 months in a year, so 440 times 12 yields $5,280. That's the total fixed electricity cost for the year. Notice that extra step because the formula is based upon a monthly calculation, right? A monthly use. So if we want to expand that for the period of a year, we need to account for how many months are in a year. In this case, obviously there's 12. So that's our total fixed electricity cost for the year. Okay, the third thing they were asking for, total electricity costs for the coming year. Okay, so now let's look at that. Total electricity costs. So obviously, we know the fixed cost is 12 times 440. Where did 12 come from? Remember, this is for an annual period. There's 12 months in a year. Each month's fixed cost is $440. So 12 times 440 will give us our annual fixed cost. Then from there, we add our variable rate of $6.10 per unit. And then multiply it by the time of machine hours that are going to be used within the period. In this case, 6,500. So obviously 12 times 440 is 5,280. 6.10 times 6,500 is 39,650. You sum those up, you get 44,930. That's going to be your total electricity cost for the year. So you can see here it's a lot just like upon it for the monthly. For a monthly calculation that we're trying to derive, instead we have to alter or amend our formula to where it justifies a 12-month period as opposed to a 1-month period. Now let's talk about scattergraph method. Okay, so this is our second method, scattergraph method. This is going to be a way to see the cost relationship by just plotting the data points on a graph. So if we can see here to the right, the scatter graph showing data points. We have materials handling cost here, the cost moving up on the horizontal axis, or I'm sorry, the vertical axis. Once again, moving to the right on the horizontal axis, the number of moves or number of quantities, what produced, however you want to decipher that. So you can see pretty much the scattergraph method. They're just plotting the data points on a graph. So you can just see they're just randomly plotted on here, right? Not randomly, they're because of an outcome, but this just for the purpose of the scatter plot, they're just shown and just scattered on the graph. So the first step in applying the scattergraph method is to plot the data points so that the relationship between materials handling costs and activity output can be seen, okay? So we can see that. We can infer that from this chart right here, right? Next, we need to inspect the scattergraph to see if it reveals one or more points or outliers that do not seem to fit the pattern of behavior. So what do we mean here? We're going to try to draw a line connected from maybe the beginning point at the bottom to the top, and then see what type of dots are just really far away from that line, is all that's saying. Well, why do this? Because this could justify their elimination and perhaps lead to a better estimate of the underlying cost function. So if we see these plots or these little plots on this chart way out there, then chances are that we could probably do away with these, okay? So let's see here one more time. If the line determined by the high and low points is going to be representative of the overall relationship of those points, then we can see right here, let's say the first point on here, around 2000, okay? We see that here. We drew a line through there, and then we drew one through the last one. You can see that it actually connects to a couple other, so 1, 2, 3 other plots with in between the high end and the low end still connect, and then there's going to be a couple that are still kind of close and a couple that are kind of a little far out there. So that's what they're saying here. It could be representative of the overall relationship. So these two plots here on a straight line right here are going to be representative of the overall relationship on this point right here. This does not give us confidence in the high-low results for a fixed and variable cost, okay? So we might wonder if the variable cost or the slope, remember the variable cost is going to be the slope, is going to be somewhat higher than it should be at the fixed cost is somewhat lower than it should be, okay? Because remember, variable slope is going to be the M, right? That's the slope. That's the variable one. M is your slope. Variable cost is your slope. Fixed cost is your intercept, right? So remember that, it's important. Variable cost is M, that's your slope. The y-intercept, that's going to be your fixed cost, right? Now finally, we can use a scatter graph to visualize the fit a line to the data points on the graph. So we can see, once again, we just drew a line here. And when you can see here, we adjusted a little bit. Instead of going straight through the bottom and straight through the top, we've adjusted it a little bit to kind of just make it more relative to the other points, make it more, try to connect them the best that we can, right? Then the manager or cost analyst will choose a line that appears to fit the points the best. Like I said, that's all they're doing here, is just trying to make it match the points the best they can. An infinite number of lines might go through the data, but this one goes through the point for January, which is 100 to 2000, and intersects the y-axis at 800, okay? So once again, the y-axis is our fixed cost, right? And at January, it goes to 100 and 2000. So let's look back and see that. 100 and 2000. When we see up there, it's about 800 for where it's on the X, or on the Y, I'm sorry. So that's a little visual of what they're saying right there. So our 2 points of concern here are 100 and 2000 and 0 and 800. So next we want to use these 2 points to compute the variable rate, which is, once again, remember, the variable rate is going to be your slope. So once again, how do we find the variable rate? What's the formula for that? It's the same thing that we use on the high-low method right here. Even though we're on the scatter graph method, it's going to be the same way, the same formula used to find the variable rate. So we can see the numerator, high point cost minus low point costs. Denominator, high point number of moves minus low point number of moves. So once again, we've got our given data up here that we're going to punch in. The numerator in this case, the high point cost is 2000. The low point cost is 800. The high point number of moves is 100. The low point number of moves is 0. So we do the math here, that'll leave the numerator of 1200, the denominator of 100, and that's going to yield $12 for the variable rate, okay? So $12 is our variable rate. That's going to be our slope, okay? The variable rate is $12 per material move. The fixed cost and variable rate for materials handling cost have now been identified, right? Because we know what? The fixed cost is going to be the y-intercept, the 800. It was given. So there's our fixed cost, 800. The variable rate, we just found that is 12, right? That's the rate for materials handling costs, right? The variable rate. And then the number of moves is going to be the quantity, or the number of moves. Same thing, right? From the other formula we were working through. So once again, the cost formula for the materials handling activity is expressed as the total cost equals a fixed cost of $800 plus the variable rate of $12 times the number of moves. So using this formula, the total cost of materials handling for between 100 and 500 moves can be predicted and then broken down into fixed and variable components. So let's look at an example. So assume that 350 moves are planned for November, okay? Using the cost formula, the predicted cost is going to be $5,000. How do we know that? Fixed cost is $800 plus the variable rate of $12 times the 350 moves that was just given to us, right? So all we're doing is punching the number of moves into the formula that we already found, right? Pretty simple there. Of this total, once again, 800 is fixed, and the variable cost is going to be made up of $4,200. Now, the scattergraph method does suffer from the lack of any objective criteria for choosing the best fitting line, okay? So once again, what does that mean? So pretty much it lacks any objective criteria for choosing the best fitting line. So pretty much what that means is it doesn't really go into detail of why we're choosing that line. So obviously based upon the line, that's going to change our slope, right? So based upon that, there's really no, like I said, objective criteria for choosing that. Okay, it's based upon assumptions of management, right, and their experience. So the quality of the cost formula depends on the quality of the subjective judgment of the analyst, right? So once again, it's based upon the knowledge, the experience, the education. All of these things factor in. Okay, so that's going to enter into the quality of the subjective judgment of the analyst or the manager, right? Now let's move on to the last method of the three, the method of the least squares. This is also known as the regression method, okay? So the method of least squares is the regression method. Pretty much it's just, this is a statistical way to find the best fitting line through a set of data points, okay? So one advantage is that for a given set of data, it will always produce the same cost formula. So that's nice. So everything's always going to be the same as far as the cost formula, right? The best fitting line is the one in which the data points are closer to the line than any other line. So once again, we want those data points to try to be as close to the line as possible is what we're looking for. Okay, so that's what we're going to use this regression thing, the method of least squares. We want to try to find the best fitting line is going to be the one with which the most data points are closer to the line than any other line. The high-low method can yield sufficiently accurate cost estimates when neither the high nor low point is an outlier. So what's that mean? If the high or low point is connecting on the line that we draw, if neither one is an outlier, meaning they're connected to the line, then they are going to yield sufficiently accurate cost estimates, okay? When the need for accuracy is going to be high, the regression method has a considerable appeal. Why so? Because the regression method is going to use all the given data points, okay? So thereby it's going to produce the best estimate possible of the intercept and the slope. And once again, what's the intercept? The intercept is our fixed cost. The slope is our variable rate, right? So that's why this is going to be so important, because these are going to go the best estimates. So if that's going to be the best estimates for that, then obviously that's going to produce the best cost analysis, right? Okay, so the value of such potential greater accuracy must be weighed against the cost of greater complexity to perform the cost analysis and even to explain it to other managers, in comparison to the less sophisticated methods such as the high-low method. So there is a trade-off here. There's always going to be some type of a cost benefit, right? Anytime you choose another alternative, you usually have to give something up in order to gain something. Sometimes it could be good, sometimes it could be bad, right? So that's what they're talking about here. So there's a cost benefit between using these. So if you get the more accurate analysis, it's going to be more difficult to explain, right? If you use the more simpler one, it's going to be more simple to explain, but you might not get as accurate of an analysis as you would have before. Let's talk about line deviations. So the regression line better describes the pattern of the data than other possible lines, okay? This results because the squared deviations between the regression line and each data point are in total going to be smaller than the sum of the squared deviations of the data points and any other line. The least square statistical formulas are going to be able to find the one line with the smallest sum of squared deviations, or the line which minimizes the cost prediction errors. Or in other words, the differences between predicted costs and actual costs. So that's we're going to try to reduce this variance by all means, okay? Okay. The predicted cost is going to be on the regression line, and actual cost is going to be the actual data points, okay? So once again, we can see here line deviation. So here's our line, right? We can just see our straight line going up from 0, shooting all the way up here. And then we have different plots here, 1, 2, 3, 4, 5. And as you can see, as we move up through here, we have four deviations here, line deviations, right? But as we get to the fifth one, then we're right on. So this pretty much is just a visual of what a line deviation is going to look like. So this is what's going to be predicted, and this is going to be the actual outcome. The difference between this plot and the line is known as a variance, okay? And the objective is to reduce these variances by as much as possible, okay? So how to use regression method to calculate fixed costs and the variable rate, and to construct a cost formula and to determine the budgeted cost, okay? So I say Blue Denim Company makes blue jeans. The company controller wanted to calculate the fixed and variable costs that are associated with electricity used in the factory. So data for the past 8 months were collected, okay? So here's the first 4 months here. Once again, we got the month, the electricity cost, and the machine hours. So with this same thing that we did on the high-low method, right? So we're looking at this again. Okay. Once again, here's the last 4 months. So this is just data that's given. Then the coefficients shown by a regression program are going to be the intercept is 321. Once again, these coefficients, the intercept and x variable 1. Okay. So what do we think these are here? These are the coefficients that we found by a regression program. Okay. Remember the intercept, this is your fixed cost. Your x variable 1, this is your variable rate. This is your slope, okay? Okay, use the results of regression to perform the following. So first they want to calculate the fixed cost of electricity and the variable rate per machine hour, okay? So the fixed cost and the variable rate are given directly by regression, okay? So once again, we get that. Fixed cost and the variable rate are given by regression. The coefficients, remember, by the regression program that we ran. So let's look at that. Fixed cost, 321, and variable rate, 638, because that's what they were asking for, right? Calculate the fixed cost of electricity and the variable rate per machine hour. It was given. Second, construct the cost formula for total electricity cost. Once again, what's the cost formula? Total electricity cost is going to be the fixed cost plus the variable rate times the units produced, right, or units used. This case, total electricity cost equals fixed cost was given. Remember, there's the intercept of 321 from our regression model, plus the variable rate, which was given, 6.38 times the machine hours. Now all we have to do is actually just plug in the number that was given, because if you recall here, 550 machine hours are budgeted. So let's see here. Budgeted electricity cost is going to equal the total cost, which is our intercept. Okay, so there's our fixed cost. Not total, fixed cost, plus the variable rate times the machine hours that are going to be allotted for. So you just do the math. 3,830 is what you yield for the budgeted electricity cost. So that's the second thing they were asking for. Calculate the budgeted cost for next month, assuming that 550 machine hours are budgeted. So once again, let's go to the third problem here. Sorry, so that's what it was, okay? Total electricity cost, there it is. Budget electricity cost there is 3,830. I'm sorry, so I worked a little ahead of myself. So let's talk a little bit about the comparisons of the different methods that we just went over. So knowing how costs change in relation to changes in output is obviously going to be essential to planning, controlling, and decision making. Each of the methods for separating mixed costs into fixed and variable cost components are going to help managers understand cost behavior and consequently make good business decisions, okay? So it's really important to know the change in relationship between the output and how these costs moves, right? Okay, some more on the comparisons of methods for separating mixed cost into fixed and variable components. So once again, we can see here the left is just the method that we use. An overview of the method is next, the advantages and disadvantages. So let's just run through these real quick. So the first method that we're going to go with is the high-low method, which is the first one that we covered. The overview of this method is just for separating mixed costs into fixed and variable components by using just the low and high data points. Remember, so we used the low and high data points, and that's how we ascertained everything else in terms of that we were looking for. Now, the advantages of the high-low method is it's objective, it's quick, it's simple, inexpensive, and easily communicated to others. Some of the disadvantages of the high-low method is the occurrence of outliers and the potential for misrepresentative data, okay? Next is the scatter graph method. This is a method for separating mixed cost into fixed and variable components by fitting a line to a set of data using 2 points that are selected by judgment. The advantages of the scatter graph method is it's simple, it's visual representation of the data. Some of the disadvantages of the scatter graph method are that it's going to be subjective, okay? So subjective, so choosing the best fitting line. So pretty much that, once again, that's subjective. It's going to be based upon the experience and the qualifications and of the professional judgment of the analyst or the cost management accountant. Lastly, the method of least squares, the regression method. This is a method for separating mixed cost into fixed and variable components by statistically finding the best fitting line through a set of data points. The advantages of the regression method is it's objective. The regression packets can quickly and easily calculate the fixed cost and variable rate. Some of the disadvantages of this method is that it's a relatively more complicated method to perform, and it's going to be more difficult to explain to managerial users of the regression output. So even though it's going to be the most accurate, the downfall is it's just more complicated method to use and to explain to others of how you actually got what you got. So now with that being said, let's talk about managerial judgment, okay? This is going to be critically important in determining the cost behavior and is by far the most widely used method in practice. So you can see how experience, education, credentials, all this stuff comes into play, okay? The knowledge of a certain industry or a certain firm within an industry, all this stuff is going to be imperative into making decisions. And obviously, like it says here, it's the most widely used method in practice, okay? Many managers simply use their experience and past observation of cost relationships to determine fixed and variable costs. This method may take a number of forms, okay? Some managers simply assign some cost to the fixed category and others to the variable category, and then just overall ignore the possibility of mixed costs, okay? So it's either going to be fixed or variable. They don't worry about some of them being split between the two as a mixed cost. Then on the other hand, other managers may identify mixed costs and then divide these into fixed and variable components, okay? All based upon management's discretion or management's judgment. Now, the use of quantitative analysis, whether relatively simple techniques such as the high-low method or relatively complex techniques such as the regression method, these can add helpful insights into variable and fixed costs beyond what judgment alone might provide. So even though judgment is the most widely used practice, the quantitative techniques, the 3 quantitative techniques that we just used, is obviously going to help bring some confidence to that judgment and bring some more accuracy to that judgment. Effective managers often estimate the cost associated with important decisions by using a combination of judgment and some form of qualitative analysis. So obviously, we want to use a little hybrid approach here. We want to use our knowledge and our judgment, right? But at the same time, we want to use some quantitative techniques to go hand in hand with that judgment, because ultimately that's gonna leave us with a better outcome based upon what we're trying to figure out. Management may use experience and judgment to refine statistical estimation results. So even though that statistical estimation results yielded what they yielded, sometimes we might use that experience to say, even though it's saying that, I think it's going to be closer to this, so let's just go with this. Or maybe they'll use like a mean or an average between the two, okay? Now, the experienced manager might eyeball the data and throw out several points as being highly unusual, or even revise the results of the estimation to account for projected changes in cost structure or technology. So once again, This is another reason why judgment of the management team is going to be so imperative, and their experience, because we know in the business environment that things are always changing, especially technology and regulatory environments and the forces that are the external forces that are coming against us, inflation, all this stuff. Okay, so obviously we need to be able to take these different components and variables and try to adjust the data that these quantitative techniques can't adjust for or can't account for. Okay, because obviously different forces can affect formulas that we're trying to use as models. Okay. Now, the advantage of using managerial judgment to separate fixed and variable cost is its simplicity. So it's very simple to use management's judgment. Okay, it's not easy to obtain the experience and the knowledge and the practice to be able to make those judgments. But once you have that knowledge and the experience and the training and qualifications, then it's going to be very simple to be able to use that, right? Now, in situations in which the manager has a deep understanding of the firm, its cost patterns, then this method can give good results, right? Because once again, he knows his industry, he knows its own firm that he's operating in. He's seen this happen a lot, so this is going to really beef up these results, right? It's going to make them way more accurate, better results. On the other end, if the manager does not have a good judgment, then errors are obviously going to occur. Okay. Here's how it's used, in this case for data analytics. So go ahead, and once again, I'm not going to get through this because once again we have a lot of stuff to cover in this chapter. Hit pause, read through these on your PowerPoints that were posted in Moodle. There's 3 slides here. I'll flip through them real quickly so you can get a little idea of what you're looking at. Okay. Now let's get back to some ethical decisions. So back to some ethical dilemmas here. So we can never escape ethics, right, with business. So there are some ethical implications to the use of managerial judgment, okay? Managers use their knowledge of fixed and variable costs to make important decisions. These decisions are going to consist of whether or not to switch suppliers, whether or not to expand or contract the production that's going on within the facility, or even whether or not we're going to hire new workers or lay workers off, okay? Now, these decisions are obviously going to affect the lives of workers, suppliers, and customers, right? Because it's all one big picture. If we lay off, if we get to a different supplier, then they're going to hurt on their end because they've lost sales revenue. If we lay off workers, then obviously our workers are going to be affected directly because they're going to lose their paycheck, right? Ethical managers will make sure that they have the best information possible when making these decisions, okay? So we don't want to make any uninformed decisions here or any just rash decisions, okay? We want to make sure that we have good data that we're using. We're really using our judgment to try to determine that, maybe we don't have to reduce the workforce. Maybe we can use another angle to reduce this, okay? To try to salvage those paychecks and salvage the well-being of those workers, okay? So ethics is going to come into play here when determining cost and the decisions based upon these different cost components. Okay, once again, here's how it is used, this time at Royal Caribbean Cruises. This has 6 slides, and once again, for the time constraint here and not to drag this lecture out any longer, I want you all to read through these on your own time. And just because I'm skipping them does not mean they're not important, because this does a great job at tying the data into a real life scenario, okay, of how companies actually use this, okay? So take the time and read through these on your own time, as it will help a lot. Like I said before, just for the sake of time, I'm not covering them in the lecture. So once again, there's 6 slides here. We'll flip through it a little bit just so you can see the idea of what we're looking at here. Okay. Okay, let's talk about variable and absorption income statements, the 2 ways of measuring income, okay? So there are 2 methods of computing income. One based on variable costing, and the other is based on full or absorption costing, okay? Let's start with absorption costing. This assigns all manufacturing costs to the product, okay? Direct materials, direct labor, variable overhead, and fixed overhead define the cost of production in terms of absorption costing, okay? Under the absorption costing, fixed overhead is viewed as a product cost, not a period cost. Recall from the last chapter the difference between a product cost and a period cost. Under this method, fixed overhead is assigned to the product through the use of predetermined fixed overhead rate and is not expensed until the product is sold. Okay, so meaning it's going to be, and fixed overhead is going to be an inventoriable cost. Okay, so meaning it's not going to be expensed, right, until the product is sold, meaning it's carried in inventory until that unit of inventory is sold. Then it enters into the determination of income through cost of goods sold, right? Now let's talk about variable costing. This stresses the difference between fixed and variable manufacturing costs, okay? Variable costing is going to assign only variable manufacturing costs to the product. These costs include direct materials, direct labor, and variable overhead. The rationale for excluding fixed overhead from period costs when preparing variable costing income statements is that fixed overhead is a cost of capacity or staying in business, okay? Such as the lease cost on a manufacturing plant. So that's going to be the justification in separating that for the fixed overhead, okay? Under the variable costing of the building of the income statements. Now, understanding variable costing income statements is important because they can provide useful insights into various capacity cost management decisions, okay? Fixed overhead is treated as a period expense and is excluded from the product cost. Okay, so once again, in variable costing, fixed overhead is going to be treated as a period expense. Okay, and is going to be excluded from product cost. Under variable costing, fixed overhead of a period is seen as expiring that period and is charged in total against the revenues of the period. So once again, let's just look at a comparison of variable and absorption costing methods. Okay, so for absorption costing, product cost. Let's look at the product cost here. Absorption costing. Direct materials, direct labor, variable overhead, fixed overhead. For product cost for variable costing is direct materials, direct labor, and variable overhead. Next, the absorption costing for period cost is selling expenses and administrative expenses. The period cost for variable costing is going to be fixed overhead, selling expenses, and administrative expenses. Okay, generally accepted accounting principles, otherwise known as GAAP, they're going to require absorption costing for external reporting. The Financial Accounting Standards Board, better known as the FASB, and the Internal Revenue Service, the IRS, and other regulatory bodies do not accept variable costing as a product costing method for external reporting, okay? So, however, variable costing can still supply vital cost information for decision making and control, which is information not supplied by absorption costing, okay? For internal application, variable costing is an important managerial tool. So what are we saying here? So once again, GAAP, FASB, IRS, they require absorption costing. Once again, let's look back at absorption costing. Absorption costing, direct materials, direct labor, direct or variable overhead, fixed overhead, right? So that's going to enter into the cost of goods sold. Then from there to get to operating income, that's going to give us gross profit. Then to get from gross profit to operating income, we back out the selling expenses and the general and administrative expenses. Remember, so that's for U.S. GAAP external reporting. Variable costing, this is for internal purposes. That's what the slide that we just went over touched on. I just want to show you the breakdown of the components of the absorption costing and variable costing, and which is relevant to internal and which is relevant to external. So about inventory valuation. So inventory is valued at product or manufacturing cost, right? So either, what do we mean by inventory is valued at product or manufacturing cost? So either we buy product for a cost, that's going to be our inventory valuation, our inventory value, or the cost of manufacturing something or producing something to sell. That's our inventory, how it's going to be valued, right? At product or manufacturing cost. Under absorption costing, product cost includes direct materials, direct labor, variable overhead, and fixed overhead. Once again, under variable costing, the product cost includes only direct materials, direct labor, and variable overhead. So once again, it's kind of a repeat of what we just went over. So let's look at an example now of how to compute inventory cost under the absorption costing, okay? So this is the one that's applicable to GAAP, right, for external reporting. During the most recent year, Fairchild Company had the following data that is associated with the product that it makes, okay? So we can just see here, get a little look here. I'll give you a second to just look at the data here, and we'll come back to it. So the three things that they want us to do. First thing, how many units are in ending inventory? Okay, so how do we find ending inventory? So let's look here. Ending inventory units equals beginning inventory units plus units produced minus the units sold. So once again, ending inventory units, beginning inventory units, that's how much we had on hand at the beginning of the period, plus the units that we produced, okay, that's going to be the goods that are available to sell. Then we back out the units sold, that'll give us how many we have left in the ending inventory. So once again, looking at the data we can see here, beginning inventory was 0. We produced 10,000 and we sold 8,000. Beginning inventory, 0, plus units produced, 10,000, minus the units sold, 8,000. So the ending inventory units is going to give us 2,000 units. That's going to be the ending inventory. So there's number one. Number two, using absorption costing, calculate the per unit product cost. So absorption costing, once again, what's absorption costing for the per unit cost? What is included in the per unit cost under absorption costing? It's the direct materials, direct labor, variable overhead, and your fixed overhead, which will yield the unit production cost. So then we just go right back and plug the given data in, right? Direct materials, 50, direct labor, 100, variable overhead, 50, fixed overhead, 25. So that's all we've done. Went in and just plugged them in, right? So this is where you really have to know the difference between what components make up absorption costing and what makes up the variable costing. So there's that answer. And then the last thing they were asking is, what is the value of ending inventory? So the value of ending inventory, remember, ending inventory units times the absorption unit product cost, right? So we know we have 2,000 units. That's the ending units in inventory, right? We found this from number one, times the absorption unit product cost, which was found in step 2. So we're just taking step 1 and step 2, and that's going to give us the value of ending inventory of $450,000. Now let's look at how to compute inventory cost under the variable costing. I know it says absorption, but really we just did the absorption here. It's just a misprint here. So now we're going to get into the absorption costing. So this one here, the variable. So once again, how to compute inventory cost under the absorption costing. So once again, same data. We'll come back to it. So now, how many units are in ending inventory? Once again, ending inventory units is what? Beginning inventory units plus units produced minus units sold. Remember, we have beginning inventory of 0. And remember, we're just pulling this data directly off this. Beginning inventory 0. Units produced 10,000. Units sold 8,000. So there it is, 0 plus 10 minus 8. 2,000 units in ending inventory. Next, it says using variable costing, calculate the per unit cost. So what components are included in variable costing? Direct materials, direct labor, variable overhead. And that's going to give us our unit product cost of $200. Once again, where do we find these numbers? Directly off the chart. Direct materials, direct labor, variable overhead. Plug it right in. So now what about the value of ending inventory? That's going to be the last thing they're asking for right here. What is the value of ending inventory? So what is that? Once again, ending inventory units found from step 1, 2,000, times the variable unit product cost, which is found in step 2. So 2,000 times 200, $400,000. Okay. So now let's just look at the comparison of the variable and absorption costing methods. It's pretty simple, really. It's just one thing's included in one and one and where it's not included in the other. So absorption costing unit cost. So this is going to be GAAP for external reporting purposes, okay? It's going to be comprised of your direct materials, your direct labor, your variable overhead, and your fixed overhead. Your variable costing unit cost is going to be made up of your direct materials, your direct labor, and your variable overhead. Okay, so that's the main difference. So once here it says, once again, the only difference between the two approaches is going to be the treatment of fixed factory overhead. Okay, as a result, the unit product cost under absorption costing, so under this one, absorption costing is always greater than the unit product cost under variable costing, which makes sense because we have a whole nother component or element that we have to account for within the absorption costing. So this is always going to be more than this right here. So let's talk about income statements using variable and absorption costing, okay? Because unit product costs are the basis for cost of goods sold, the variable and absorption costing methods can lead to different operating income figures, which makes sense. The difference arises because of the amount of fixed overhead recognized as an expense under the two methods. So let's take a look at this. Once again, same data here, okay? Now we're going to prepare an absorption costing income statement. So first thing we want to do is we want to calculate the cost of goods sold under the absorption costing, okay? Cost of goods sold equals absorption unit production cost times the units sold, right? So we've already found the absorption unit production cost, right, from the last example. Units produced, okay, units sold, 300 per unit times 8,000, okay? So we found the absorption unit produced, product cost, right? Sorry, let's start over. Solution, for the cost of goods sold, calculate cost of goods sold under the absorption cost. And sorry, I just chopped that up. Cost of goods sold equals the absorption unit product cost, okay, we just found that, the 225, right? Times the units sold. 8,000. The unit sold was given to us in the data that we just looked at. So 225 times 8,000 is 1.8 million. Then it wants us to prepare an income statement using absorption costing. So we know the income statement, absorption costing income statement, okay? The sales, we sold 8,000 units at 300 each, right? Remember that was given up here. Units sold, 300 per unit. We sold 8,000. There's our sales. Less the cost of goods sold of 1.8. We found that here, 1.8. Because first we know the unit sold, it was given 8,000, but the absorption unit product cost, remember, that's comprised absorption cost, direct material, direct labor, variable overhead, and fixed overhead, okay? So that's going to give us the cost of goods sold there, or I'm sorry, that gives us the absorption unit product cost times the unit sold, which was given. So that's the 1.8. Once again, that's going to be our cost of goods sold, 1.8. So we know sales less cost of goods sold will give us our gross margin of 600,000. 2.4 minus 1.8 is 600,000. And then from there we back out the selling and administrative expenses of 100,000, okay? Which once again, fixed selling administrative expenses was given of at 100,000. So that's the absorption costing income statement, okay? Next, how to prepare a variable costing income statement. Once again, we have our given data here, same data. Calculate the cost of goods sold under variable costing, okay? Cost of goods sold equals variable unit product cost times units sold, okay? Remember, the variable unit product cost in this case was made up of direct material, direct labor, and variable overhead, okay? Times the units sold, which was given 8,000, remember? 8,000 units was sold. Okay, so the variable unit product cost, 200 times the units sold, 8,000, is going to be 1.6 million. Notice here, obviously the cost of goods sold is going to be less under the variable unit production, right? The variable costing income statement as it is under the absorption one. Because why? Remember, this does not include fixed overhead in the variable costing, whereas the absorption costing does. So product cost will be higher, right? So if product costs are higher, then cost of goods sold will be higher under that one. That's why cost of goods sold is less in this case, okay? So cost of goods sold, 1.8 was on the absorption. Cost of goods sold is 1.6 on the variable costing. Okay, so now let's look at the income statement. It says prepare an income statement using variable costing. Once again, sales same. We sold 8,000 units at 300 each. 2.4 million was our sales revenue. Then now we want to back out the variable expenses, okay? Which is going to be the variable cost of goods sold, the 1.6. Remember, in this case scenario with the variable costing, this variable cost of goods sold is only based upon the product cost that was inventoried on the direct material, direct labor, and variable overhead. So that's why it's less on this case right here. Variable cost sold is 1.6. So therefore, if our cost of goods sold is going to be less, then obviously our contribution margin, our gross profit, is going to be more, right? It's going to be 800 as opposed to the 600. And then from there, we want to back out the fixed expenses. So in this case, remember, now we're going to use, the fixed overhead of 250, which was included in the other part on the other one, and now the fixed selling and administrative expenses of 100,000 here. So we'll sum those up over here of 350,000, back them out from our contribution margin or our gross profit, and it'll give us operating income of 450. So once again, how it says the use of the income statements prepared either using the variable costing income statement or the absorption costing income statements could produce different operating incomes. They're obviously going to produce different operating incomes because the product cost is going to be different. So that's going to throw off our gross profit. So if the gross profit is different, our operating income is going to be different. So under the variable costing income statement, we can see the operating income is 450,000. Whereas on the absorption costing, the operating income is going to be more of $500,000. Okay, which makes sense because we're taking more selling and administrative and period expenses away for the variable one as opposed to the absorption one, so the operating income will be less. So there's just a little bit of the difference between how to prepare the variable costing income statement and the absorption costing income statements, and how it can really throw off the difference between your gross margin and your operating income. And if we recall from last class period, we really dug into these different breakdowns of the multi-step income statement here with the gross profit and your operating income and so on and so forth. Okay, so next let's talk about production, sales, and income relationships, okay? So the relationship between variable costing income and absorption costing income changes as the relationship between production and sales change. If more units are sold than were produced, variable costing income is greater than absorption costing income. So let's just take a look at this real quick. It's just a little chart here, and I believe this is going to be the last chart here, and then this will be the end of this chapter's lecture. So once again, this is going to show the production, sales, and income relationships. So in the first case scenario, if production is greater than sales, then absorption income is going to be greater than variable income. If production is going to be less than sales, then absorption income is going to be less than variable income. If production is going to be equal to sales, then absorption income equals variable income. Okay, so that's going to be the breakdown and then be the relationship among production, sales, and income relationships, okay? Let's just make sure this is the last point. It is the next topic is the Appendix 3A using the regression programs. And once again, I'm not going to get into that on this lecture here. I think that I've already thrown enough material and content your way. So that wraps up Chapter 3. Once again, dealing with the cost behavior and forecasting. Pay attention to this lecture, read through those examples of how it's used at real companies to try to see the relationship between the two and help break down the explanations. Be on the lookout for your Chapter 3 quiz and Chapter 3 homework assignment. I'll have those posted here in the next day or so be on the lookout for that. If you have any questions or concerns with any of the material that we've covered, please let me know. Shoot me an email, give me a shout. I'll be more than happy to help anyone out that's struggling. That's what I'm here for. So once again, that's it for Chapter 3, Cost Behavior and Forecasting. And once again, be on the lookout for the homework and quiz for Chapter 3. Thank you for your time, and I will see you all on next Monday. And once again, I apologize for having to cancel our lecture for this evening. Hopefully, we'll be back in the classroom on Monday, but I will keep you posted. Thank you for your time, and everyone have a good day and a good rest of your week.